2021, the return was 9.4%. The return was 9.4%. In 2022, the return was 8.2%. And in 2023, the return was 5.6%. Obviously, the Tribers are smart enough to understand that is currently that is below the inflation rate, right? So the question is why? Why is it that low?
I think that's a very interesting question and a very good question. And I would just like to take us back a bit, right? Just to understand how this scheme works, right? So one, I would just like to start by saying how this product is structured is that it's a long-term real estate vehicle, right? Meaning year one, the return could be X, the return could be X, year three, the return could be, in this case, 5.6%. Right? But how you should look at it is in the sense that you've invested from, let's say, year one. And as you invest in real estate, you look at it long term. So you look, for example, of a holding period of 3 or 5 years, right? And in this sense, if you actually look at if you have a platform, it's your platform, the return actually accumulates year after year, right? So again, it's an investment that can weather the storm. Right? At times the return will be lower, right? At times it will be higher, right? And again, even as we discuss the return, because I know the next question is, so why was the return lower? Right? And I just want to venture into explaining that for just a few minutes. Right? So, for example, specifically in 2023, the return was again impacted by two things. Right? And to explain this, we need to understand the business model of the REIT. Right? Let's go. Yes. So for this investment, it's highly pegged on us, the REIT manager, being able to raise enough capital to acquire properties on time. Right? Now, as me and you know, Kenyans still don't believe as much in the capital markets, and it's one of the things that is our job, that we're trying to educate Kenyans on how to invest in the capital markets, right? We're trying to move away from this thing where we believe to have wealth, you must have a physical asset, right? Now, because of the lead time it takes, right, to raise enough capital to acquire these properties, we have to supplement it with debt. Right? And this debt will enable us to acquire the property and again position the investment for the long term, right? Because we're not just thinking today or year one or year two, we're thinking of it as a long-term investment. So as we acquire more properties, economies of scale increase, right? And the return will continue becoming better and better. So we acquire properties and we position the product for better returns in the future. Now, for example, in this case, for example, in terms of the returns we had this year, right? In 2022, for example, we took a debt of around 750 million, right, to help us acquire Kwetu, Hurlingham, right? Now, this debt was fully paid out in 2023 together with the financing costs, right? Again, in 2023, we had to take a short-term debt, right, of around 1.5 billion to enable us to acquire Kwetu Abadel Heights 2, which is the one in near USIU, right? And this debt was just to help us position the product for the long term. Remember, each year we try and acquire 2 new properties.
That's a goal, right?
So the impact of this again had a 1.8% to be exact impact of the dividend, right? So dividend yield we've said is 3.6. If we didn't need to supplement with that, the return would probably been 5.4% of our target.
5.4 around
7% of the dividend, right? But again, it was very important for us to do this because again, we position the product for long-term growth, right? We're not here then tomorrow or next year we've disappeared. So as an investor, as you continue holding investments, you will enjoy the returns. As I said, it's here to weather the storm.